Kia ora. We're rapidly approaching yet another year end, and no doubt we're all looking forward to some well-earned time off with our loved ones. But in keeping with that year-end theme, what I want to do today is take you through 6 themes for 2026 that the bond team think are going to be impactful on markets. While 2026 is going to be a pivotal year for domestic politics, there is a general election due by December 26 at the latest. And if we look at the polls today, it's a coin toss as to who would be able to form a government. Now, there's a couple of key implications there. The first is, given the closeness in the polls, there is uncertainty at play in terms of the legislative framework companies and individuals could be operating under. At the margin, that might see some expenditure held back until there is more certainty. The second important thing is the impact on the size of the government bond issuance program. If we look back to Budget 2025, the largest line item saving was removing pay equity pledges. If the left bloc comes to power, those are certainly back on the table. Budget 25 put the costs at $2.7 billion a year. That'll need to be financed through the issuance of additional government bonds, which will put upwards pressure on yields. We're asking ourselves, will Trump's wings be clipped? Currently, the Republican Party has a small majority in both the House and the Senate, and that has allowed them to pass their various policy endeavours, such as Trump's Big Beautiful Bill and various trade-related policies. Now, if you look at the data historically, the incumbent president's party has lost seats at the US midterm elections. We can see this in the data going all the way back to the 1930s. What's more interesting is that the number of seats they lose is quite correlated to the support rating for the president. And today, Trump's rating has been heading south. Now, should the Republican Party lose either the House, the Senate, or both, that essentially means an end to the legislative phase of Trump's presidency. There will be political gridlock as the Republicans need to seek bipartisan support from the Democrats to pass legislation. It will increase the probability of government shutdowns when the US inevitably butts up against its debt ceiling. What that means for markets is that there is going to be some volatility, particularly in those key 10-year yields. And the US is the global reference for all other fixed interest markets, so that could flow through to New Zealand's market. Dr. Anna Brennan has taken helm at the Reserve Bank as governor. She is going to serve a 5-year term starting from December 2025. In her maiden speech, she highlighted that she's going to have a laser focus on inflation, but also that she wants to improve the communication and transparency of the Reserve Bank of New Zealand. Dr. Brennan comes from the Riksbank, which is one of the most transparent central banks in the world. And there are 3 key areas that we think she might bring over from the Riksbank to the RBNZ. The first is around attributing comments in the statement to the individual committee member who made them. The second is around vote attribution. Currently, votes are not disclosed in terms of which member voted one way or the other. And the third is around general availability to the media. Currently, we only have press conferences after the monetary policy statements. We expect she might want to have them after each and every meeting. Now, to make some of these changes, she's going to need support from our Finance Minister, Nicola Willis. And indeed, in interviews, Minister Willis has indicated support to help improve transparency. Now, what this all means for the market is that we might see opposing views in the public for the first time between committee members. And that might cause a bit of volatility as we try to figure out how to interpret these opposing views in terms of what the OCR is going to do on a go-forward basis. Well, 2025 was a challenging year for the economy, but when we look forward to 2026, we have every reason to expect improvement. In fact, we're actively looking for signs of green shoots starting to blossom, and we're seeing them. We can look at business confidence. It's running at an 11-year high. Consumer confidence, it's still in pessimistic territory, but there's a clear uptrend occurring from when the Reserve Bank started easing. We can look at card spending, a very clear uptrend of increased spending since the Reserve Bank started easing. We can look at the ANZ Truckometer. Now, this is a fantastic index. It's got a high correlation with GDP growth, and it represents goods moving around the country. It's going up, indicating there's more activity occurring. We can look at building consent numbers, and again, there is a nice little uptick occurring. Now, not all consents result in building activity, but essentially, the greater the number of consents, the more potential future building activity. We can look at vehicle registrations, which show the same uptick in level, showing that businesses and consumers have enough confidence in the future to make what is, in most cases, a relatively large investment decision. We can even see it in our search history. If we look at a couple of keywords, builder and renovation, we see they are at relative high levels of interest over the past 5 years. Indeed, this recent strong uptick lines up quite nicely with when we think the Reserve Bank moved into stimulatory territory. The need to adjust your thought process from how low the OCR is going to go to how long it's going to stay at what is a stimulatory level. Now, when thinking about that, we should be aware that monetary policy has a lag of between 12 months and 18 months to its maximum impact. Add to that the general elections, which we previously touched on. They are due to occur in roughly a year's time. Then we spoke about green shoots starting to blossom. Yes, that is occurring, but they're not yet in full bloom. So the recovery is gradual, and that gives us confidence to believe the OCR will stay on hold for all of 2026. Well, first of all, we need to remember that New Zealand is a AAA credit. Our debt to GDP level is significantly below other key global economies, and I could point to the US, the UK, France or Japan as alternatives. If there ever is going to be a crisis in government debt, it's likely to occur in more indebted nations than New Zealand first. Then let's look at our credit market. It is of very high quality. Most of the entities that we finance are very defensive in nature or are government adjacent. And that means their credit is going to perform well through both the good times and the bad times. Then third thing, we have a very steep interest rate curve in New Zealand. And what that means is that we are paid to take on term. For example, we can buy a 10-year government bond today at around 4.5%. That is significant carry over where the OCR is today at 2.25%. The curve is also really steep, and that adds another source of return, which we call roll. How steep is our curve? Well, it's roughly twice the slope of what you see in Australia or the US, and that's a great thing for bond investors. And then finally, if you're weighing up your defensive allocations between global fixed interest and domestic fixed interest, without trying to be too biased, I think domestic fixed interest stacks up quite well for all those reasons I've just mentioned, but also as a New Zealand dollar-based investor, if you are to hedge your offshore exposures, currently there's quite a high hedging costs in the range of 1% to 1.5%. So there we have it, 6 themes for 2026. Domestic politics at play, impacts of uncertainty, and on the government bond issuance program. The US midterm elections, potential gridlock in the US, impacts on our long bond yields. We have a new transparent Reserve Bank of New Zealand. We're going to see opposing views in public at some point. There might be volatility. We have green shoots starting to blossom. Keep an eye on those blossoms. We have to adjust our thought process from how low the OCR is going to how long it's going to stay at stimulatory levels. Think in terms of at least a year. And then we need to remember that despite the easing cycle being behind us, domestic bonds still have a place in a diversified portfolio.